All right. So among the slew of announcements made by FM Sitaraman in the union budget, one that has made the headlines is the proposal to increase the tax collection. Tax collected at source or TCS at 20%. Now, this has come at a time when direct investing in foreign markets has become popular due to high returns it gave in the past, along with the diversification it offers to one's portfolio. Now, let's welcome on board Yash Upadhyay, Chief Strategy Officer at 5paisa.com, and Harshvardhan Roongta, CFP Roongta Securities, to understand how investors will be impacted by this. Yash and Harsh, welcome to the show. Harsh, first question to you. I would like to understand the announcements here on TDS that's been made in the budget and which will impact your investment in the foreign markets.
So, hi Kavita. Well, the impact that is going to have is on only on the investment portion of the foreign remittance. So, if you know, there are a couple of reasons why a person would remit funds overseas. So, one would be, of course, for educational purposes for their children, and it could be even medical reasons. So, there is no change in the tax collected at source, the TCS on these payments that you remit outside. In case you are remitting money outside under the LRS, the Liberalized Remittance Scheme, wherein each individual is allowed to invest up to $250,000 every year out of the country. Now, if you're undertaking that kind of an investment to either buy into stocks, bonds, ETFs, or property for that matter, then there is a tax which has been increased from 5% earlier to now 20%. So the agency through whom we are going to route the payment, they're going to they're going to collect a TCS of 20% now in place of 5%. So the impact essentially is that there will be a larger amount of money which is going to get blocked. Now, if you were to remit, say, for example, $10,000, now 20% of that will be collected as tax at source and 8,000 will be remitted. So the $2,000 that you will have in this case will be adjusted against your tax liability or on the income in India, or you will get a refund after you file your income tax return.
Yash, how do you look at this announcement?
Yeah, so definitely what I see from this announcement is government is trying to reduce the Indian investors' money going out of India. So previously in budget 2020, uh, they imposed a TCS, but uh, it was for the money transferred through LRS scheme above 7 lakhs. Now they have removed all the upper limits and lower limits. Now even if you're transferring 1,000 rupees or 1 lakh rupees, there will be a 20% deduction at source. Now the impact of this will be uh, the portfolio that essentially you want to invest in US markets, it will be reduced by 20% upfront. You can definitely claim this amount later on during your annual income tax filings, but that will impact your overall return earning potential from the US markets.
Okay, and which is why we are doing this discussion today. So, Harsh, does this mean that there needs to be a review in the strategy, if at all you have one, where you're investing in the foreign markets, or that's really not needed?
Just just the fact that there has been an increment in the tax collection at source, I don't think that should change or alter the allocation you make to international markets. Well, you're investing overseas for a particular purpose, and not that there has been a drastic change in the product that you're investing into. It's just that earlier, when there was a 5% TCS collected, now a larger portion of your money is going to get blocked. That does not change the attractiveness of the product that you're investing into overseas, if at all, if there is anything. So I'm sure there is another reason why you're investing. The government undertakes certain practices only to ensure that one, if the TCS was a lower figure, if it's say 1%, for example, the idea is not to collect tax. The idea is to have a reporting system in place. So the moment there is a transfer, there is a TCS collected and it gets reported to the government, and then X amount of money has gone out of India. Now, when they've increased the TCS amount, the intent is to retain more money into the country and discourage investors from going out. That does not mean the product that they were investing into overseas that has changed. The nature of that product has changed. So I don't think it has become less attractive. Just that the liberty that you had, say for example, $250,000 is the limit. So you will have only $200,000 now that you can remit out actually in form of foreign exchange, and $50,000 for that matter, 20% will be lying back here in the form of TCS. So I don't think the product has changed. Just that okay, there is going to be a larger amount of money which is going to get blocked now.
The process is streamlined. There's definitely more transparency. But then, talking about discouraging investment going abroad, Yash, I think we should elaborate more on this now, and this should be the focus point of discussion also, because we want to help our viewers understand as to, despite this particular announcement, why should they still stick to investing in the foreign markets? Now, people who are already invested, why should they continue or discontinue? And people who haven't yet, should they be diversifying into the international market or not? So, first question to you on this particular line would be, right now, do you think international markets are attractive for one to diversify in their portfolio?
Yeah, definitely the international markets are attractive. So there are two ways that you earn money through international markets. So one is the absolute return that you see in your capital, and the second is the return that you generate through dollar appreciation. So if you look at the data for the past 5 years, if you just look at the S&P 500 data, the average CAGR for S&P 500 is around 10%, and during the same period of time, dollar has appreciated from somewhere around 63, 64 to 80 to 83 levels right now, which is again a 5% CAGR. So the overall return from US market would be somewhere around 15%. At the same period, if you look at the Sensex returns, it is somewhere between 12 to 13%. So actually, the investors who had invested in the US markets, they would have gained additional 2 to 3% by investing in US markets during the same period.
Sure. All right. Harsh, the same question to you. I want to understand ways through which an investor can invest or maybe have a part of their allocation in the portfolio in the international markets.
So, well, Kavita, one of the simplest forms of doing this, if you do not want to get into opening any or registering yourself with an international broker, etc., for a retail investor as well, for a person who invests really a small amount of money, wants to invest on a monthly basis, and just like an SIP, there are international funds offered by domestic mutual funds. So you'll have all of our mutual funds a regular way, the schemes that you invest in regular form, you can just pick an international fund, international scheme, and invest it through an SIP in INR, um, just like you do in any other mutual fund scheme. So that is one of the options which is always open for investors to undertake. And the other, of course, if you're a little more well-informed investor, you want to take that, you want to go ahead with investing directly, you can always register with an international broker, which facilitates an investment into an international stock exchange. Through the on the platform. So yeah, there are a couple of options that are available that you can always exercise.
There's a direct equity option and there's an option of going through a mutual fund. Now, Yash, help me explain, help me understand this particular concept that's been introduced where the TCS has gone up, has been hiked. If at all I'm investing through a broker or I'm investing through an AMC, how does this impact my transaction or my investment strategy?
So if you're going through the mutual fund route, you don't have to worry about anything because AMC will have to take care of the changes in the LRS scheme. But if you choose a route where you are directly investing in ETFs or stocks, for that essentially you have to convert your INR money into dollar. That's where the LRS scheme comes into play. So what it essentially means is, let's say as an investor you want to invest 10 lakhs in US stocks. Now, when you convert your INR to dollar, you will get dollars worth of 8 lakhs only. 2 lakhs will be the tax will be the upfront tax that you have to pay. Now, this tax is not something which has been deducted, but it is just a blocked amount which you can claim later on during your annual income tax filing. Now, all your investments in the stocks will be through that will be using the dollars that you got from your 8 lakh worth of money. Now, there are multiple options to invest in US stocks directly from India. That is something which you can do even from our 5paisa app. We have a partnership with Vested. So, essentially, any Indian broker which has a partnership with US registered broker, the transactions in US stock markets can be facilitated through that.
So, Harsh, now let's understand the kind of economies we should be picking up in this times, in this turbulent times. In fact, which would be that international market that one can actually go for, or maybe can be slightly bullish, or maybe have a slight exposure in their portfolio.
So, well, Kavita, I am an advocate of investing into developed markets. The reason being because if you look at the emerging market side, we are already invested in India. So, we being Indians, we have a majority of our investments in India. So, if you have to cover the emerging markets, India, I think, is the best market, and we already have a lot of exposure. Now, in terms of diversifying, if you're looking at markets which are different in nature, then of course the developed market would be a better option. So, for an investor, the developed market, there are two options. One is, of course, if you look at purely US, then you will have schemes which are like replicating the Nasdaq 100. You have S&P 500. You have schemes which are actively investing into selecting stocks of the or listed overseas. You have a developed market index fund. So wherein they have investments into not only US but other developed markets across the world as well. So I think very clearly the theme should be, or the fact an investor should keep in mind, what are you actually trying to do when you go overseas? Are you only investing because you want dollar returns? No, that's not the case. You really want to invest into companies which otherwise are not listed in India. So US, I guess, is one of the markets that you can look at, or any other developed market which is different from that of Indian market.
So, Yash, in the same scenario, if I want to talk about having a stock portfolio or a direct equity portfolio that deals with only international equities, how can diversify into international markets in a by having a direct equity portfolio?
So if you're talking about the retail investors, if they want to directly invest in the stocks, I would suggest they should go with the big names only, because US markets operate very differently from India, and sometimes they are very volatile as well. So if you want the exposure of the overall market as well as the themes, maybe you can go for US, some US tech ETFs, or ETFs which are benchmarked to S&P 500. That way you can get exposure to the overall US markets.
Harsh, what would be the process to buy direct stocks, and how can one do it? Is
Well,
it recommendable?
so see, it is ideally a product for investors who can invest at least at $10,000 and above in a year. Because if you invest about $1,000, $2,000, it's not going to be worth it while putting in all the effort to set up a infrastructure. So the idea is, yes, you have many domestic institutions or brokers who have tie-ups with international brokers. Now these international brokers will offer you; they will be registered on one of the exchanges overseas. So it's a very direct and clear link. So you punch your transaction of buying through your Indian representative. In turn, there is a backward backend integration with the foreign broker, and then you can buy your stocks, and then you get a account statement per se to say that you have investments in that. You don't have to have a demat account because shares won't get transferred in Indian demat accounts nor over there. There'll be a custodian who will give you a confirmation that shares worth XYZ value in these companies is lying in your name with us. So you will have a confirmation, and it is pretty smooth. Pretty smooth in that sense. Just that if your investment amount per annum is going to be less than $10,000, it's not really going to help you do anything much. In fact, if you have a retail amount to invest into, then I guess the international schemes offered by domestic mutual funds will be better.
Now, the schemes are offered by domestic mutual funds, Harsh, and also the brokers who give the service of transacting internationally in stocks. What would be the cost of transaction or the breakup of the entire costing over here?
Okay, so when you talk about the international schemes
Hmm.
like of domestic mutual funds, I mean, they are going to have a TER, the total expense ratio that we have, the fund management fee. So that will probably range that will be in the range of 1 to 2%. So that is the kind of expense that you will incur. But you're investing in INR, and this Indian rupee investing is not covered under the LRS. So you don't touch your $250,000 limit. It doesn't fall under that limit. And when you're looking to invest into international stocks directly or ETFs directly through a broker, then there will be a brokerage charge. There will be an account opening charges. There would be some other conversion charges because there's going to be a forex conversion that you're going to undertake. There will be those charges that you will have to bear and while transferring. And of course, the TCS that we spoke about, 20% of whatever you transfer is going to be held back by your transferring agency. So if you're using a bank to transfer money or a money transfer agency, They're going to hold back 20% in the form of TCS. So these are going to be your costs when you invest directly and vis-a-vis when you compare it to investing via an international scheme in mutual funds.
So, Harsh, similarly, what would be the tax implications?
So, well, the taxation over here is treated as a debt security. So, though you're buying equities internationally or you're investing in an international fund which is investing in equities overseas, but all international investing is considered as debt investment. So, anything that you sell, any profit that you make within 3 years is going to be added into your income and you're going to be taxed as per your marginal rate of tax. And in case it's a long-term capital gain, then there is going to be indexation benefit and 20% tax that you have to pay on that.
All right. So, Yash, now talking about mutual fund schemes and talking about active mutual fund schemes which were offering international exposure via their mutual fund schemes. Now, that being capped, and a lot of them, in fact, started investing again, and again it's been stopped. Do you recommend a passive way which is better for investors?
Uh, yeah, so I think investing through ETFs is a good way, but investors should look for a long-term investing, because if you're trading very frequently, the charges are pretty much high, and they will eventually eat up all your profits, because you lose around 1 to 2% in the uh, forex conversion charges. Plus, there will be some withdrawal charges. Plus, there will be some purchase charges as well. So, if you're investing in the foreign markets, keep a horizon of at least 4 5 years. Maybe you can look for a SIP kind of investments through ETFs.
So that's all about overseas investing, which we've tried explaining our viewers. Harsh, we would request you to stay back, but then that's all with you, Yash, today. Thank you so much for being on the show. And on that note, let's take a quick break, and we have Harshvardhan Roongta with us, who will be further answering your portfolio queries after this break. Welcome back. You're watching the 80 Money Show with me, Kavita Thapliyal. And before we move on to our queries section, here's a breaking news coming in. FMCG major ITC has declared its Q3 earnings, and it seems like their profits have beat estimates, coming in at 5,021 crore. Seems like margins too have improved, coming in at 38% versus 34%. The company will also pay investors an interim dividend of 6 rupees per share. Vinny Motiwala is joining us to break down those numbers for us. Vinny?
Absolutely, looking at the numbers, first cut seems like a strong set of numbers coming in. Revenue in line, profits of the company above estimates, margins of the company also above estimates. Now, in terms of the revenue growth, around 2.3% is what the revenue growth came in at. Revenue was at around 16,226 crore rupees. Now, talking about the profits of the company, 21% growth on a year-on-year basis, and the margins have seen a sharper expansion than what we were expecting. We were expecting EBITDA margins to come in at around somewhere around 34-35%, but they've come in at 38.4%. So strong expansion in terms of margins on the year-on-year basis as well. Cigarette business too has done well, around a 17% growth in the cigarette revenue. Major portion of their revenues do come in still from the cigarette business, so around 60% or a bit more, you could say, comes in from the cigarette revenues. FMCG business, 18% growth on a year-on-year basis. Agri business this time around has seen a bit of a decline coming in, so that is a factor that we were not keeping in mind. But yes, that's a decline of 37% in the agri revenues. Hotel business, like expected, has seen a 50% jump in terms of revenues, and paper business too has seen a 12% jump, given the favorable base in both the hotel as well as the paper business as well. Now, in terms of cigarette EBIT, that has seen a growth of 17%, while FMCG EBIT has also seen a good growth of around 44%. So, all in all, we could say it's a good set of numbers. We'll keep an eye out on what the cigarette volume growth number comes in later on as well.
Thank you so much, Vinny, for that breakup of the numbers. And we move on, and let's connect with Harshvardhan Roongta, because there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? On the 80 Money Show, we have on board Harshvardhan Roongta, CFA Roongta Securities. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865 07974574571, or you can email us your queries on the money show at etnow.tv. So Harsh, we also have the first viewer question. We have Dinesh Verma's question first, and he says that he has a lump sum portfolio of 8 lakhs, and the kind of funds that he has in the portfolio are Axis Small Cap, SBI Small Cap, Parag Parikh Flexi Cap, Axis Mid Cap, and Canara Robeco Blue Chip, Motilal Oswal Nasdaq Fund of Fund. And he wants to know that to these funds and this portfolio, can he accumulate corpus for his retirement? And the time horizon for this particular goal is 20 years. Now, we don't have him on the phone line because this is all a lump sum investment he's done. I wanted to understand that if he's willing to do an SIP further on. But then, okay, up to you now. Let's start with the fund mix.
Fine. So I don't have a problem with the specific themes that he's added into his portfolio. Just that one observation I have, he's investing about 40% of his investments. The allocation of up to 40% is into small caps. Well, there's nothing really wrong in doing that in case you've taken a very conscious decision to be into small caps and allocate that kind of money. I'm personally of the view that, I don't really advocate a dedicated small cap to this extent at least. So I prefer that if an investor would put his money into a multi-cap or a flexi-cap fund, the fund manager can cherry pick the small cap companies that they find which is going to be worthy of investment. Unlike if you're putting into a dedicated pure cap small cap fund, then the fund manager is compelled to pick into the small cap companies whether or he or she is not fully convinced in buying as well. So I think a flexi cap or a multi cap would be a better approach to invest in the small cap. However, as I said, if Mr. Dinesh has taken a conscious decision to allocate so much into small cap and take that risk over 20 years, then the schemes are fine and he may continue in that case.
All right, we move on to our next question, which is from Riddhi. She says that she is 32 years old. She is working with an MSc. Monthly income is 60,000 and she can invest a maximum of about 15,000 per month in mutual funds. She wants to have a corpus of 8 lakh in next 10 to 15 years. Currently, she's investing in PGI Mid Cap Fund, SBI Magnum Mid Cap and SBI Small Cap Fund. And she wants to understand that if she should be sticking to these funds. Now, very aggressive, only mid caps and small caps. Tell me.
Yeah, what Riddhi has done, I mean, she's kept a target of 80 lakhs. So I guess if you assume a return of about 12 to 14% over the next 15 years, she should be very close to her targeted sum. So that doesn't seem to be that much of a concern. Like, just that how you pointed out that the entire 100% of the portfolio into mid and small caps. So again, nothing really wrong in this approach, but it would be better if you're looking at a much larger time horizon. It's going to be more of a asset allocation strategy, not like a tactical allocation where you just stick to mid and small caps. So just one change I can suggest in case she wants to do it. She can stop the SBI mid cap and invest into a large cap index fund of SBI itself. So if she already has a folio, the transition will be smooth. She can pick the SBI Nifty index fund in case she wants to move out of one small cap and go into a large cap index fund. Again, to say this, that in case she wants to take that mid and small cap 100% allocation and wants to take the risk, then everything is fine and then she can continue. Then she doesn't need to make those changes as I'm suggesting.
All right, so I have to go on a break, but then one question I want to ask on behalf of Riddhi, in fact, two questions. You suggested a change in the mid-cap fund. So why she should be coming out of SBI Magnum mid-cap and why a passive for large cap?
Okay, so because she already has two mid caps in her portfolio, so one is a PGI mid cap, the other is an SBI Magnum mid cap, and then the third one she has an SBI small. So the easiest thing would be to move one mid cap into a large cap because she already has two of them. PGI is a good mid cap fund. She has an SBI small cap, which is again very good. So mid cap, not that SBI mid cap is not a good scheme. Just that if you had to make a change, that was the best option that you had amongst the three. And I suggested a large cap mid cap fund, large cap fund, index fund for the simple reason she already has a folio with SBI. So the transition will be very smooth and she need not go through the entire process of creating a folio all over again.
And by adding a large cap scheme, she'll have better stability in her portfolio as well. Thank you so much, Harsh, for being on the show and helping our viewers with their financial plans. And on that note, let's take a quick break.